Good afternoon, everybody. I think we're ready to get started. First, thank you all for joining and welcome to the Greenwich Associates webinar titled Fixing the Liquidity Problem at the Source, Innovating Corporate Bond New Issuance, brought to you in partnership with our friends at Overbond. I'm Dan Cornell. I will be your host today. Soon I will be joined by Kevin McPartland, Managing Director and Head of Research in our Market Structure and Technology practice here at GA. We'll also have Vuk Magdalenic, CEO of Overbond, Mike Nappy, Vice President of Investment Grade Corporate Bond Trading at Eaton Vance, and our own John Colon, Managing Director for the Banking Markets here at Greenwich Associates as part of our panel. So we're excited about that. Before we jump in, let me just cover a couple of housekeeping items. If you are hearing an echo, which does happen, please make sure you have telephone selected in the GoToMeeting frame. That will take care of that. Questions are welcome throughout the presentation, so please type them in the question box. We'll answer as many of those as we can as we go through the webinar. If we don't get to your questions or you have additional questions after the webinar, we are definitely going to provide contact information for you at the end of the session, and we'll be happy to get to those after the session concludes. A quick note to members of the media that may be on the line: if you are interested in quoting any of our presenters today, please reach out to the individuals directly for their permission before quoting them in the media. And then lastly, after the event, we will be asking you to participate in a brief survey. Let us know what you like about the webinar, maybe things that we can change and improve. We're always looking to see how we can better serve. So before I turn that over to Kevin and our panel, let me take a quick moment to tell you a bit about Greenwich Associates and the market structure practice here in particular. In the Market Structure and Technology Group, we're focused on changes in the ecosystem of the institutional financial services market, whether they be regulatory, technical, macro, microeconomic, or even political, and how they may impact market structure and market participants. Our core differentiator, as we see it, is that we conduct a tremendous amount of primary research, which forms the basis of all of our analysis. In fact, this year we'll ask over 3.5 million questions to our study participants. That gives us a tremendous depth of content to dig into when we do our analysis and opine. So hopefully we're using that in order to provide our clients confidence with the insights and analysis that we do and information that they can rely on. So with that quick bit of marketing out of the way, let me turn it over to Kevin and the team.
Great, thanks Dan, and thanks everybody for joining today. So we're here to talk about the corporate bond new issuance process. Before I get into a little bit of research and start the conversation, we want to get the sentiment of the audience here a bit. We're going to put up a poll question if you can take a minute to respond to that as I get started. The question being, how do you view the current new issuance process? Is it fair and efficient? It works, but it can be made better, or it's broken, in dire need of innovation. So please put your thoughts in there as we get started. So I'm going to start off with a little bit of Greenwich Associates research just to help the conversation along. We and many others have done a tremendous amount of research looking at secondary market trading and corporate bonds. The headlines there have been around electronic trading growth, the reduction in balance sheet on the dealer side, and how that's changed the market structure. That is certainly a big story for sure, and there's been a tremendous amount of investment and technology put towards solving that changing market structure and the problems that come along with it. But what doesn't seem to be getting as much focus is the new issuance process. The new issuance process has been on the rise really since the financial crisis. You can see from the chart on the right, if we look at U.S. corporate debt issuance since 2008, the growth has been pretty dramatic, and this has, left investors, with a sort of a large universe of bonds to choose from. It's also been increasingly easy for issuers, whether they be investment grade or even high yield issuers, to gain access to the funds that they need at relatively low interest rates. But the recent increases in rates coming from the Fed have told the market that a bear market in bonds really is on its way. And as rates rise, the cost of borrowing, of course, rises along with it, which should make new issuance slow down quite a bit. Further improvements in the secondary market infrastructure, as I just mentioned, around liquidity, trading technology, that will also make it easier for investors to get access to the bonds they need, whereas over the last several years, they've really relied on the primary markets. And then lastly, the use of loans has also grown as an alternative for raising money for corporations. And you can see a bit of that here. Loans, which sort of traditionally have been a big instrument for European firms to raise money, have been increasingly popular with U.S. firms as well for a variety of reasons. The new issuance market, while it's had a bit of a bull market on its own, and while that won't go away, it certainly looks to slow down, and some more efficiency will be needed there. Before I ask my first question, I'm going to stop so we can take a look at the poll results. Good. So you can see it's actually a bit sort of pretty positive view. It does work, and I guess if we look at the growth in issuance, that is proof that the market has been working, but certainly can be made better. And I think that it's that it can be made better part that we're going to focus on over the rest of the conversation. Okay, great. So with that, let me get back into the conversation. So Mike Nappy, sort of sitting on the trading desk at Eaton Vance, a large asset manager. Can you talk a little bit about sort of what you've seen over the last year, how you feel sort of the primary market has worked, and how you see that changing as interest rates start to rise?
Sure, Kevin. I would say, the last 3 years really has kind of been really the same. Maybe the issuance numbers are slightly up year over year as you look back for the last 3. But I'd say the overall trend of, busy calendar days in both large, $5 billion and over kind of mega deals, as well as the days where you have, you might have 15 issuers come on a really busy day. If a lot come, with a single tranche. I'd say lately, last few weeks, and I think the numbers would bear this out, that maybe investors are getting a little more concession than they had been getting. And that could be a couple of things, time of year, market tone, those sort of things driving that right now. But we'll see concessions kind of increase and decrease slightly. And it's by no means large concessions, but some of these deals now coming 5 to 10 in the last few weeks, where they've really been coming flat. But I'd say that kind of flat to 5 basis point concession seems to have been the norm over the last 3 years. I think your chart here on the issuance, kind of bears that out, or I guess 4 years if you're looking at that chart. And it's been I say to our PMs all the time, there's really 2 markets, at least in investment grade. I'm speaking solely on investment grade debt. There's the new issue market, and then there's a secondary market, and they really trade and behave, independently at times. And that's really happened since the rise of the issuance coming out of 2008.
Great, thanks. And John Kola, maybe you could talk a little bit about sort of how the markets have been from a corporate issuer perspective.
Sure. Well, obviously, I think at the time of the financial crisis in 2008, which is starting to feel like history, people were incredibly worried about access to financing. But it was impressive how quickly those worries really diminished. So I would say that within sort of 12 to 24 months, people still had some concerns about the availability of bank financing, but the debt capital markets were surprisingly wide open, and it pretty much stayed surprisingly wide open. There's been the occasional hiccup from the repetitive Greek debt crisis, et cetera, where some things kind of slowed down or looked a little bit ugly for a while, but they've all been pretty fleeting. And I think that's been true of, the market broadly. Our being consultants, we tend to try to put everything into some sort of plot or matrix. But if you think of on a sort of a y-axis, frequent issuers ranging to infrequent issuers, and on an x-axis, kind of plain vanilla investment grade ranging over to more complex sort of instruments, you do get pretty different characteristics around those. And by complex, it could mean a number of different things. It could be odd maturity, odd features, odd structure. High yield, obviously, will tend to be a little bit more complex than will a straight investment grade issue. And even the reason for the financing could add some complexity. Is it basically normal operating funding and they're just rolling debt over? Or are they making a strategic acquisition that requires them to be fundamentally kind of changing their capital structure to fund that acquisition? But Mike may just sort of disagree with it. I think when you get into that frequent issuer, plain vanilla investment grade bond world, you could argue that those are bought, not sold, meaning that the companies are well known, the credit quality is well known, issuers are looking to issue in multiple different tranches, maturities, basically to feed investor demand. And they've got kind of the flexibility and sophistication to do that. When you move into that more complex world, that's where you'd say you've still got instruments that need to be sold.
Sure.
High yield, the most obvious one, where it starts to look a little bit like equity, and you're worried not just about credit quality, but what's the growth potential of the company, what's their business model. Probably need to kind of think about the market not so much as a monolithic, debt market, but really along some of these different dimensions, because those will have really different characteristics to them.
Yeah, no, it's a great way to think about it. And Vuk, you would sort of work with both sides, the issuers, the investors. Where do you see everybody lining up around? To John's point, right? There's sort of I guess you could almost call them the flow products, the flow issues, and then some of the more complex stuff. So what are you hearing from your customers, and where do you guys play?
Yeah, Kevin. So on the issuer side, obviously it's a flow. I would agree with you. So continuity is the name of the game. So sustainable, boring program, running it for obviously accessing the marketplace frequently. On the issuer side, we often hear the investor engagement and investor diversification being something that's important to treasurers and CFOs out there. And then on the investor side, it's more around, it's surprising to me sometimes how much energy and effort in research and in looking at both fundamentally and then who might come to market next, right? How much time is spent on a buy side. So the opportunity discovery becomes a value add. Like if we were to know who's the most likely next, let's say corporate IG issuer that's going to come to market, and then how that gets prioritized in terms of what access can I get, what would be the price, and perhaps the best match for my portfolio. So those are the things we're hearing.
Yeah, no, and with that, I think another important point to bring up, and I'm going to sort of go on to the next slide, is the dealers in the end, while obviously still a big, the big driver in debt capital markets, are not sort of holding the bonds in the secondary market anymore. You can see this is a chart that I suspect anybody that's on this call has seen, numerous times over the last several years, how dealer inventories and corporate debt have just continued to decline. So where are those bonds going? We see the new issuance going up and dealer inventories going down. Those bonds are sitting somewhere. There's a longer list of regional dealers that are involved, and they're picking up some of that debt. To a lesser extent, non-bank liquidity providers are starting to play a bit of a role, particularly some of the ETF sort of ARB type firms that have some balance sheet are starting to hold. But really, in the end, and I'm going to sort of take this back to Mike, it's, the asset managers are housing, a majority of the corporate debt, right? Like John said about it being sort of, bought, not sold. And by asset managers, that I think would also include some of the ETF issuers there as well. So yeah, I mean, Mike, have you seen, your role has evolved, where you sit in this marketplace, your role has evolved. Has that, changed your interaction with the dealer community, both for new issuance and secondary market trading?
A little bit. I think the biggest challenge for us is finding the time, on the very busy days. And I think going back to the poll that you asked at the start of this, I think one of the reasons folks leaned the way they leaned was, I think everyone experiences it. I think the sell side guys experience it. I think we experience it on the days where there are 8, 9, 10 issuers and a bank has 5 or 6 deals. It's really busy for everyone. We're certainly not, I don't think anyone in this industry would consider themselves overstaffed anymore. I think that's well known. So, we're asking folks to do, to kind of juggle a lot, specifically on the sell side. And then I've said this for a few years now, I think it makes it really hard to, or harder to focus on a story bond. If there's an off-the-run credit that I'm trying to buy that particular day or that particular week, and it's a heavy new issuance week, my problem's twofold. It's getting, kind of dealer focus at times, getting my focus at times, and then whoever the other side of the trade is, right? So I may not even be busy that particular day with the calendar, but if all my peers are and all my counterparties are, it can make it challenging to get things done. I think you hit on a very solid point about, who's holding it. I think we're all holding a majority of it, and as flows continue to come in, both asset managers and ETFs, we need a place to invest. I think this is why you've seen some issuers bring deals they may not have normally brought to market, or tap deals. It may not be M&A, and to John's point, that is a big piece of what we've seen in the last few years, definitely, especially in certain sectors, right? Pharma and TMT, you've seen a lot of that, but just in general, it's a very healthy M&A environment. But issuers will come because they can, and frankly, the appetite's there. Why investors, I think, are fine with minimal concessions right now is because the concession is really the supply, right?
Yeah.
It's the one place you can go and get what would otherwise be, say, a $400 million, outstanding REIT. That when you go look at the holders and you see it's basically put away, I'm not going to be able to buy those bonds if they have a 26. But if they come with a 27 or they tap that 26, I'm going to have an opportunity to get size. In some cases this year, we've actually seen openings or taps of deals or new deals actually tighten the entire curve because, bonds are kind of artificially wide because they didn't really trade that often. So the demand is definitely there. The demand continues to be there. It'll be interesting to see. If we have a significant rate backup, if that changes. I've been hearing it's going to change for the last 5 years, and it hasn't. So, and from our standpoint, we closed on our acquisition of Calvert, almost a year ago now. And, for example, we're typically in the market for those strategies for green bonds. And green bonds are just hard to find. I mean, there's not a huge secondary market for them. So for us, new issue, the new issue market is huge, for that particular strategy. And in other strategies, it's not as important, but it kind of varies. And I guess I just end with, not all new issue, and I think John hit on this as well, but not all new issues the same, but it doesn't have to be IG and high yield. There's your on-the-run names, Alibaba's in today, Amazon will come with a massive deal, and Apple and Verizon and all the names we know. And yeah, you're right, they probably don't have to be sold, and a lot of that's roll.
Sure.
When you're a $350 million, REIT that's come twice lifetime, that it's still IG, but that's where you're seeing syndicate play a role in setting up calls with management and that sort of thing. So there's really two markets within new issue. There's the super liquid, and then there's the less liquid that just kind of exists within IG. And what makes kind of talking about all this as one is that dynamic. And in a lot of ways, it's a lot like the bond market in general when we talk about electronic buying and transparency and that sort of thing. The same opinions don't necessarily hold across the entire space.
Yeah, for sure. So Vuk, does that sort of changing role, in some ways the changing role of the dealers, which has in some ways changed the role of all of the market participants, has that changed the way that the sort of issuers interact with the sort of the end investors?
Yeah, I think, there's something to be said. If you look at the chart that you've shown, look at dealer inventories. Those inventories were there for market making, and we obviously see, a liquidity kind of prevail. So the question becomes, what will substitute that kind of supply and demand matching function, right? And is there enough supply? Mike, I think, alluded to it a little bit, and, slice it or dice it, within the IG sector or the entire kind of deeper, higher yield sector as well. I think there's something to be said about, how can we better match supply and demand for the sake of perhaps having an option to participate in primary in a new format, or better understand who's coming at what time, so on a busy day you're not you know exactly what the executable flow is. So our focus, based on that kind of feedback from both issuers and investors, was to work on algorithms for supply and demand matching. And I think that's a trend that we'll probably see unfold going forward.
Sure. And John, is that, from an issuer's perspective, has their relationship with the dealer community changed a bit? Are they then interacting more directly with asset managers?
Yes and no. The sort of, I guess, dirty little secret of the business, it's not really, I guess, a dirty secret. Dealer selection is still, to an enormous extent, driven by whether or not that dealer is a provider of credit to that company. It's still, in many cases for corporates, a litmus test. If you're not willing to lend to us, why should we give you additional business? From the standpoint of many banks, providing credit is a loss leader. They don't want to do it unless they think they can get access to other parts of that company's, quote, wallet, which would include things like debt capital markets fees, but also interest rate derivatives, FX, cash management, et cetera. And in fact, when you look at it from the dealer side, you'd say that there's no lack of alternatives for pretty sophisticated, capable organizations. So there are a number of banks who are capable of lead managing transactions, and lead managing complex transactions, and lead managing transactions in other currencies. And so in a lot of cases, tiebreakers come down to something quite tangible, like, again, are they willing to lend? Are they part of my credit group? And in some cases, intangibles, just the strength of the overall relationship. It was interesting, the comment about green bonds. One of the things that we're finding a number of companies actually quite interested in is the notion of sustainable finance. And that may seem like a little bit of a flash in the pan, but green bonds are part of it. Or how do you minimize the carbon footprint of your supply chain, which then ties into your trade financing and working capital. So there are some considerations that come into the mix beyond just the pure capability of the dealer directly within bonds. Credit's the biggest one of those, but you'll get some other factors that will go even as far as, again, what are their capabilities like in products like green bonds if it's a company that's focused on sustainable finance.
Hey, before we continue, this is Dan again. I got a question here with respect to the Canadian market, asking if we have any information on activity in the Canadian market and what do we see as trends there?
And Boo, you want to pick that one up?
Sure, yeah. What we're seeing, obviously, it's a healthy issuance market. There's obviously not as many active participants in, just from sheer number of entities, both on the issuer and investor side. But the process is largely similar. We look at it from the operational lens. So I think a lot of themes we've picked up on are definitely, how things work in Canada as well. So you've got, DCM syndication units covering issuers and investors, and large deals are distributed in that fashion. I think there's a need, given the liquidity, and I'll just allude back to that, and in terms of what we're doing in Canadian marketplace as Overbond, for better supply and demand matching, and that information flow that perhaps doesn't filter as much, so it's more of an all-to-all information flow, regardless of what type of deal will transpire. There's that healthy inbound investor interest, and then on the back of that, demand gauge that issuers can then act on.
Sure, makes complete sense. Another maybe a comment and question as a follow-up. So in IG, the market is quite bifurcated in that you have relatively small number of players that issue frequently and in size with large notional amounts and outstandings across maturity points. So with a large issuers forming the backbone of the market, how do you incentivize these guys to standardize issuance across product features in the issuance calendar, if in fact you can? From our discussions with large issuers, they feel that a pre-announced issuance calendar puts them at a disadvantage. What do you think about that?
I mean, from my perspective, I've certainly read pieces, regarding the standardization. I personally don't think we ever see it. Certainly in my career, I think the biggest issue is, what do you do with everything that's out there? It's you just can't clean everything up. Now, if we could go back in time and kind of understand what the market's like today, could it have been done, 20, 30, 40 years ago? That would have been the time to do some of that. There's just too much outstanding right now that even if you had the most common issuers, standardize their benchmark deals, I don't think it makes a dent in terms of what it's. I mean, I understand what it's trying to accomplish, but I don't think it makes a dent in that. And then it comes down to what's kind of the point. I also think if you're a treasurer, to the thought of having to standardize if you're a certain size, or a serial issuer versus a company that is not, it creates a little bit of an unfair playing field. So I personally don't think we.
Yeah, I would agree it's going to be hard to get there. I think in part because the market hasn't necessarily been willing to pay a lot for it, right? So if I'm an issuer and somebody says, oh, by the way, you can shave off X basis points from your financing cost by having these features be standardized, there's a clearing point. I'm not sure what that clearing point would be, but I don't think we've really had an active market, if you will, where people can clearly say, oh, if I change X and Y feature, my rate's going to go down 5 basis points. That's worth it to me. So again, I think they're rational economic creatures, and if we get developments that say, all right, here's what you'll save, then people will be more willing to hop in that boat.
True.
Great. It also eliminates the standardization is going to eliminate to a degree. If you look at the treasury market, right? I mean, you have your on the runs and your off the runs, but for the most part, the curves are pretty linear. You have certain credits that have credit curves that don't necessarily look the way you would forecast them, and that's kind of the art of the investment grade market. When does it make sense to sell 27s and buy 24s and vice versa? You don't have that dynamic in treasuries, so it's easy to standardize and kind of have this notion of an on-the-run. And you certainly have on-the-run corporate bond issues, but to imagine like a nice linear credit curve for me is kind of hard to think about.
Right, because it goes back to the real need for borrowing money, which is to grow and build a business, right? So they're not designed to help traders. They're designed to help the businesses operate.
Correct.
And to that point, right, the current issuance model, and I think we've talked about that a bit, really hasn't seen a tremendous amount of change over the last decade or so, if not longer. The balance sheets of the large dealers, they're not going anywhere. The market needs those, so I don't think we should expect any change, so fundamental at a broad scale. But, of the folks we've spoken to, very few would disagree with the notion that technology and more innovation really is needed here. And I'm going to go back to Mike in a second as the sort of the person in the trenches. But there's still a lot of spreadsheets and messages and emails that go on, in the sort of early communications with the issuers and the banks, the allocation process, again, sort of very manual. Mike, you already talked a little bit about how harder it can be to manage on a busy day, dealing with all of the issuances. So, it does feel like, you're sort of taking what we have today and applying some new technology with it. We certainly can make this whole process more efficient. So, yeah, Mike, I will go back to you. Maybe you could just sort of talk about what that's like, sort of what that process is like. The technology, the emailing, the spreadsheet, sort of how do you deal with that day to day? And then we'll kind of go back to John and Vuk to get their perspectives on how things might evolve.
Well, yeah, I mean, I guess I would start by saying emails and spreadsheets would actually be a step forward. I think the biggest issue right now, and it varies bank to bank, and some are a little more strict than others in regards to who can put what in writing. So before this call, I had to get book color from one of the three dealers in the pot over the phone because they're not allowed to put it in the message. And I certainly understand the reasons behind that. The frustrating thing, I guess, from my standpoint, there's no standard, right? You have some folks that will, some folks that won't, some folks that their messages can be forwarded. I would say it's probably the norm now to see price talk in messages, but 2-3 years ago, you'd never see that. Some dealers have messages set up as forwardable, non-forwardable, firm forwardable, and it's just inconsistent. And then when you couple that with the fact that it's not run like high yield, at least with IG, and you're talking to 4, 5, sometimes 7, 7 dealers, or that you're taking incoming from, that really makes the process, it bogs the process down. I understand legally why banks, have the guidelines they do, but without even getting into how do we inject, kind of some futuristic type of, tech into the space, if we just brought it up to speed with what the rest of the market's seen for the last 5 years, I think it'd be a big improvement.
Sure, and I mean, Vuk, as a technology provider in the space, I mean, what are you guys thinking? What are you seeing? What's the low-hanging fruit to improve the process?
Yeah, that's actually a great way, I think, to think about it, was the low-hanging fruit. Because we talk about standardization. To me, and in general, when we thought about, okay, well, what we can do with technology first, second, third, right? I think it starts with increasing the connectivity amongst parties, right, in a digital way. And I actually sympathize with what Mike's saying in terms of complexity in different venues or methods to communicate. So if you kind of have that standardized channel and connectivity, and by that I mean looping in treasurers in this connected hub, and that's what we are focusing on, and then making information available. So that when you see it, obviously, sometimes I don't know if it's as widely, understood how much complexity a large issuer has on its own hand, if it's an active IG issuer, sometimes multiple issuing entities, looking at multiple markets, monitoring its entire peer group. So there's a lot of operational intensity on that end as well, let alone buy side. So if you kind of have that connectivity information availability and let an algorithm perhaps match supply and demand in a new way that would just give higher starting points, then our premise is you would help people make decisions, build confidence around whether we're going to have a go or no go to go to market on an issuer side, or whether this is a credit we like on an investor side.
Right, and I think that sort of goes to what we're seeing in other parts of this market and other markets in general, right? It's not about sort of automating the process in such a way that you don't need people. It's about using the data that you have at hand to help the people involved make better decisions, right? To give them more information.
Yeah, more confident.
For sure. And then, yeah, John, from an issuer perspective, I mean, what have we heard from the corporates about the process and how things might move forward?
Well, it's not specific to the bond market, but the major pain points that they cite in their relationships with banks generally are typically around anti-money laundering regulations and know your client regulations. And they find them to be incredibly burdensome, and for some of the reasons already mentioned, in the sense that different banks interpret the regulations differently. That's just within the same market. Then you start to put that in motion and add in overseas markets, where again you've got different rules and regulations. Some of the comments around what you can and can't put in a message, that's being made more complex by MiFID II, where you got to be really careful about whether or not something is considered to be research, and if it is, you have to pay for it, and how do you pay for it, and how much do you pay for it? It's an out-of-date number, but going all the way back to 2013, JP Morgan was talking about spending $1.5 billion on compliance and risk management. That's one of the largest, most sophisticated banks you could find. Multiply that by all the banks out there, you got a massive amount of money that's being put into these requirements. And it also just points out how hard it is for somebody outside the top tier to break into some of these areas, because they just can't afford that level of regulatory and compliance expense. So the dealer side and also the corporates are really interested in any sort of workflow solution that facilitates and eases these particular pain points, whether that's centralized document depositories, whether it's electronic signatures. All of these sorts of elements are ones that people are actively looking at to say, God, how can we just free up our people and not have so much of our time being buried in some of these compliance and regulatory requirements?
Sure, yeah, and coincidentally, we've released another piece of research today unrelated to this webinar, but where we found that the banks are collectively spending about $20 billion in reg tech annually, right, which goes from your estimates from a few years ago. So it's a tremendous spend, but a lot of it is to get give the desk time back. They're spending an inordinate amount of time with compliance these days. So that, fortunately or not, is part of the process.
Yeah, I think the other unfortunate thing is that a number of banks have decided that people are dangerous. Because when you look at a lot of the really large regulatory settlements, it's because somebody on a sales desk did something stupid or said something stupid. Well, one of the ways to protect yourself from that is find ways to eliminate the people. So when you talk about that investment in reg tech, some of it is artificial intelligence, systems, processes that, remove the human factor, and in that way try to control the potential for, crossing the wrong line from a regulatory perspective.
For sure. So, and another paper that Greenwich released today also deals with the technology on the desk and how that's evolved, and then how that interacts with the human communication portion between the buy side and sell side. So, two pieces.
For sure. So we're getting a number of great questions from the audience. We're going to get to those in a minute, but before we do, we have one final poll question that we want to put out to the audience, and then we'll sort of continue the conversation. Which of these changes do you believe would help the new issuance process? And we picked a few of our favorites, so we'll get a gauge from the audience sort of as we keep talking. But there's a number of more questions. One, I think we could touch on about emerging markets and how that primary issuance market looks. We talked a little bit about the U.S. and Canada, but any thoughts from any of the panelists on what's happening in emerging markets?
What I think we've tended to see is, and probably on that very first chart we showed that showed kind of debt capital markets and then syndicated credit, bilateral credit, et cetera, we should have flipped it around because kind of syndicated and bilateral credit is sort of the foundation of people's debt financing, and they sort of layer debt capital markets on top of that. But you see that that sort of traditional bank-driven financing is a much higher proportion in Europe than it is in the U.S. Well, it's simply because you don't have as big, as deep, as liquid a market in Europe as you do in the U.S. You don't have as many big companies. You don't have as many frequent issuers. So you quickly get to companies that have to rely more on banks or not frequent issuers, et cetera. Now, Europe has seen that line in terms of company size where you can credibly go to the capital markets kind of steadily moving down, both in terms of investment grade, also non-investment grade. More companies coming out, getting some experience, getting into the markets. And it's really been similar in the emerging markets, where you've got a lot more companies that frankly just still don't have the size to credibly issue. They're more reliant on traditional bank financing. They're in fact more reliant on traditional bilateral financing. But that line and the number of companies that actually do have the potential to issue, it's gradually been getting deeper into the marketplace. Market's getting a little bit wider, et cetera. Now, that's not to say that, we don't get another emerging market hiccup and everybody runs for cover, but, the gradual slow trend has been for markets to become a little bit deeper, a little bit broader, a little more liquid, and that's allowed companies that historically would not have been able to issue to begin to do some issues.
Great, thanks, John. So we're going to bring up the poll results. And I think the audience seems to largely agree with the comments thus far. Nobody said the bank should have a greater role, which is notable. But technology to eliminate manual processes, and maybe Mike, if we'll put that one to you for comment, and then after that, 20% more direct interactions between issuers and investors, and Book will put that to you. But Mike, we talk about that. I mean, where of the manual stuff you did, you said email and spreadsheets would be an improvement. I mean, what would you love to see that would make your day a little bit easier from a tech perspective?
I think we're starting to see it, in spots. Within, Bloomberg terminals right now, they're working on a function that, in theory, is going to kind of aggregate all the, broker messages, and it's kind of a pin board that day for new issue. Even that's really been an improvement, I guess I kind of get it, under the hood a little bit with how we do it. We use message tagging within the terminal and within email that basically is looking for anything that says new issue or non-deal roadshow, or to basically put those messages in a folder so we don't miss anything. Otherwise, the amount of stuff we see, you would miss it, especially a single-led deal by a bank, say, on earnings day. When you just got one guy giving it to you, you don't have the redundancy that you have, when you have a pot deal. So then we take all that information and we actually use the combination of, chat, spreadsheet, email to disseminate it. Because what makes it a struggle is it takes the desk, and some shops have dedicated folks to the new issue market. We did that for a little bit, and it works, and there are pros and cons to doing it. But we take all that information and we get it in a way that we can disseminate it, and then I basically got to play the role of the bank salesman and make sure all my PMs and the other traders that need to see it are aware of it. And then I got to collect all that information, and then go back to all the dealers, with any orders or with any feedback or what have you. And that's just on the new issue piece. Road shows and color back from road shows. It's just a lot of manual, kind of massaging of data.
Sure.
A start, but before we get into any kind of allocation transparency or, ways to take the orders in and some of these things I've heard kind of kicked around, just a place that you can go in and see on a particular day, hey, here's the calendar. If I have a morning where I'm a little late in, to sit down in the seat and have to comb through messages to kind of get up to speed, that's when you really notice it, right? And you kind of think, geez, what, why isn't there just one place I can go and look? Now, I will say it's been slow, but I feel like a majority of the dealers are kind of, I think they think the same way, right? It's like we have a lot of, if I'm a dealer, I'm looking at the Salesforce and looking at the desk saying, we have a lot of smart, capable people that we're paying to do a certain job. Is calling with price talk, something we want, a salesman doing to his 20, 30 accounts every single day on multiple deals on multiple mornings every week? Or do we want that person focused more on, something that requires a little more thought and it's maybe more interesting for that person? And
Sure,
by the way, could also generate revenue for said bank. So, that's kind of I think where we're at. It's just starting to tip towards a little more automation. And I think that's positive.
Great. That's great.
Right. Yeah. Let me, I'm going to throw one follow-up question over to Vuk that we had on the topic of the concerns that were recently raised both in the UK and over here about some of the potentially quote-unquote unfair allocation practices used by dealers, preferential treatment to big clients on oversubscribed new issuance, for example. How do you incentivize large issuers to issue on an open platform, possibly bypassing the dealers? The issuers we talked to mentioned the dealers using bundled pricing. For example, if you want to secure a credit line to back up or CP issuance program, right? So, Vuk, what do you think of that?
Yeah, I mean, it's a big question. For us, we're thinking about getting all parties on a connected hub. So Overbond obviously connects issuers, investors, and allows them to really in a more algo-enhanced way get their price transparency unfiltered, right? Assess the priority in terms of if you're a buy-side participant, who's coming to market next, and why is this opportunity, important for me? So what's kind of the match there? And if you think about that, that suite of tools we call COBI, Corporate Bond Intelligence, but what it really does, it allows for more opportunistic gauge whether the timing is right and more opportunistic issuance from an issuer side where you kind of have all of these investors in a very diversified, unfiltered fashion expressing interest to you. Now, when it comes to a point that the confidence has risen to the point that we're ready to issue, it largely sits within the issuer's discretion whether they want to issue in this format or the other format. And it would be ambitious to kind of say we have a clear point of view how issuers will act at that point in time, whether I want to launch a public style benchmark size deal, fully syndicated in a classic format through the dealer community, or I want to perhaps do something a little smaller, more opportunistic on a one-on-one basis. But the premise here is that you would have data and data transparency to have a very informed conversation in either scenario. And I think that will be a strong influence and kind of a, forward benefit to avoid some of the situations you mentioned.
Great. Super. I know we're getting late, and we've actually run a little bit over our intended time. We do have another dozen or so questions. I think we're gonna try to answer those offline and come back to you directly if we can. Apologies for that, but we do try to keep the time frames in check. So with that, let me thank first of all Book, Mike, John, and Kevin, and everyone on the line for your participation today. If you have additional questions, please reach out. There's our contact details on the screen. We would love your feedback, so please take a moment to answer the survey, and we greatly appreciate that. And then a last reminder that for folks that find it important, remember that the webinar does qualify for AFP recertification credit, as you saw on the invite. So make sure you take advantage of that. So with that, thanks everybody for your participation. We'll be back with another topic quite soon, and everybody have a great afternoon. Bye for now.